I want you to be prepared in this topic since I'm expecting 100% cooperation from you that you can compute and interpret the financial statement ratios.
Ratio analysis expresses the relationship among selected items of financial statement data. The relationship is expressed in terms of a percentage, a rate, or a simple proportion.
You have here example of vertical analysis of an income statement, no, of XYZ company. So as you can see, you have there items for cost of goods sold, the gross profit, expenses, and the net income after tax. Now, our base here would be the net sales. So, saan siya pag-compute? To compute the net sales, you have there the amount 880,000, divide it by the base amount, which is the net sales itself, that is 1 times 100. So we come up with a 100%. Cost of goods sold, you have there 260,000 pesos. So that will be divided by 880,000 as our base amount times 100. So the resulting figure we have 29.55%. Now, this 29.55% class is a component, now part siya of the net sales. So, meaning to say, if you're going to interpret that one, we only have 29.55% out of the 100%, no, for our cost of goods sold. So, as you can see, gross profit is greater than the cost of goods sold. The first type of ratio, the liquidity ratio, or determines the capacity of a company to pay its current obligations. So this would require a good amount of your cash and other liquid assets. So when we say other liquid assets, we discussed this already in FABM1. Now we have the accounts receivable, inventory, trading securities, and even mga prepaid expenses. Actually, class, these ratios are very important, no, to the short-term creditors of a company because it will determine if the borrowing of the company is in a position to pay the borrowed principal and interest when they fall due. So to better understand the financial ratios, let's have an illustrative example of the computation using the sample financial statement of ABM company for the year 2019 and 2020. So first, that we need to compute to determine the liquidity of a certain business is the working capital. Okay, working capital class is also known as liquidity capital. Kindly read the definition, David.
The difference between current assets and current liabilities. This is one of the simplest liquidity ratios. A positive working capital is preferred because it would mean that there are enough current assets to pay all the current liabilities at the moment.
What is the formula to compute working capital?
Working capital equal to current assets minus current liabilities.
Okay, very good. So since we are using the two comparative period, no, for ABM, we have here 2019 and 2020. So get the current assets. So let's go back to the previous slide. So let's check if the current assets in 2019 is 1,410,000. Okay, correct. No, so we have here 1,410,000. Then for 2020, we have 1,510,000. Now these figures will be subtracted by the current liabilities. So for 2019, we only have 450,000. Then for 2020, we have 500,000. Now get the difference. Now very simple formula. So the working capital for 2019 is 960,000 pesos. And for 2020, we have 1,010,000 pesos. Okay, my question is, which of the two period has a good result? Junel.
Mas dako sila kita ay kapital sa year 2020.
Okay, meaning to say, for both period, the company has a positive working capital, but for year 2020, this gives a positive impact, knowing that ABM company is in better liquidity position for that specified year. Ngano na kayong tag-better kay mas dako, ha? mas greater ang value sa 2020 kaysa ni 2019. Kindly read the definition of current ratio, Carol Angela.
Yes, ma'am. Current ratio is the quotient of current assets divided by the current liabilities of the company. As much as possible, a whole number current ratio is preferred. Formula: current ratio equals current assets divided by current liabilities.
Okay, so dili ni siya dapat makalimtan, no? Very simple siya not to i-familiarize. Okay? From the word current ratio, of course, you will only get the quotient, no, of both current assets and current liabilities. So kuhaan lang nimo ang yang quotient. Now, ang atuhang interpretation ani, for every 1 peso of current liability, there is an equivalent 3.13 peso of current assets. So, ang pangutana karon, kaya bang bayaran sa company ang iyang utang? Yes. Nga naman, mas dako man ang value ni current assets, di ba? Kaysa ni current liabilities. Okay, that's the interpretation. But for 2020, we only have 3.02. So meaning to say, for every 1 peso of utang ni company, there is an equivalent 3.02 current assets. So which is better? Asay mas maayo ani nga result? Okay, kindly give your interpretation for this, Eliza. Which is better, 2019 or 2020?
2019, ma'am.
Okay, 3, we have the acid test ratio. Kindly read the definition. Len Jaisel.
Yes, ma'am. Asset test ratio. Asset test ratio is a more strict variation of the current ratio formula. It removes inventory and prepaid expenses from the numerator component. Only cash, receivables, and trading securities, also known as quick assets, will be left. So, ang apel formula, ma'am.
Yes, kindly give.
So, the formula is asset test ratio equals to quick assets divided by current liabilities.
Okay. Now, before we can compute asset test ratio, we need to determine first the value of our quick assets. So, from the word quick, no, paspas nga mga assets. So, unsa man yung mga paspas aside sa cash, we have the accounts receivable, the interest receivable, the trading securities, no, and other quick assets. Now, to eliminate other current assets, kay if you can recall, no, in our working capital, we use current assets, di ba, as our numerator. This time, we will not use current assets, but we have to eliminate some of the current assets, no, such as prepaid expenses and inventory. Nganong kwaon man nato siya, kay dili ni siya quick assets. Dugay ang ihang conversion. So that's why we have to eliminate those assets. So kung pila lang ang mabilin, mao na siya nga itong i-consider as quick assets, then you have to divide it by current liabilities. The same divisor with the current ratio. Okay, anaha, dapat dili nato kalimtan. Basta may yung tag-asset test, we are to determine the quick assets ratio. Okay, ABM company has 2.04 peso worth of quick assets for every 1 peso of current liabilities for the year 2019. This is something positive, right? It means that the company has the capability to pay its maturing obligations through quick assets. Unsay pasabot ato, ma'am? Kayang bayaran sa company ang iyang mga utang gamit lang ang mga quick assets. So comparing both years, no, for the year 2019 and 2020, it would reveal that the company was better off in 2019 compared in 2020. So kung ganina, kani si current ratio, mas better ang result sa 2019 compared to 2020, the same na di ay gihapon sila sa asset test. Accounts receivable turnover ratio, kindly read the definition, Shannon Lay.
Accounts receivable turnover ratio. This ratio measures the frequency of conversion of the company's accounts receivable to cash. It measures how many times the company collected its accounts receivable from its customers.
Okay.
Formula: accounts receivable turnover ratio equals net sales by accounts receivable.
Now, we have here, now using again the data of ABM company, we'd be able to compute the company's accounts receivable turnover ratio for the 2 years. So, we've seen no, that the company has a higher ratio in the year 2020. So this can be attributed to a better performance from its collection department. So paspas na ko no ang pag-collect. Kay when we say accounts receivable, si customer ang nangutang ani. That's why the company recognized accounts receivable. So pag dako-dako no or taas ang number of times nga makollect ang imong receivable, pasabot daw anak class, effective ang company in terms of collection policies. Average collection period. Eliza?
Average collection period. The average collection period states the usual number of days it would take before the company would be able to collect a certain group of receivables. The accounts receivable turnover itself is a component for the computation of the average collection period. It serves as the denominator in the formula. For the numerator, the company makes use of either 360 or 365 days depending on the policy of the company.
Okay. What is the formula?
Formula is average collection period equals 365 days divided by AR turnover ratio.
Or accounts receivable turnover ratio. So, kana siya, mao ni siya ang kaganina. So, kung pila ni siya, mao ni atong gamiton as our divisor. So, kanang number of days class, magdepende siya sa policy sa company. Unsa i-adapt. It's either 360 or the approximate days or the 365 or the exact days. So, the average collection period for the year 2019, we have 21.91 days. For 2020, we've got 20.77 days. So, what is our analysis? Ang atong analysis for average collection period, take note that the shorter average collection period, it shows that collection department increased its efforts to collect company receivables as they fall due. So, inventory turnover ratio, Junel, kindly read the definition.
Inventory turnover ratio. This ratio measures the numbers of times the company was able to sell its entire inventory to customers during the year. As much as possible, the goal is to have a high inventory ratio. A high turnover ratio shows how efficient the company is in selling its inventory to customers. Formula: inventory turnover ratio equals cost of goods sold divided by inventory.
Okay. So again, lahi pud ang focus sa inventory turnover. Atong i-determine unsa kapaspas ang pagbaligya, ang pag-dispose nimo sa inventory. Okay, using again the data no for ABM company, we can compute this by dividing cost of goods sold by inventory. So for inventory turnover ratio in the year 2019, we have 2.38 times, no? 2.38 times siya mahalin. For 2020, the cost of goods sold is 1,300,000, inventory is 470,000. So the inventory turnover ratio is 2.76 times. So which is higher? Okay, the number of times nga mahalin ang imuhang inventory for the year 2020. Kanilang gid siya. So, mas slightly better ang 2020, 2.76 times. Now, let's proceed to number 7. Average days in inventory. Kindly read the definition, Escarnil.
Average days in inventory. This ratio states the number of days that it would take before an inventory would be entirely sold by the company. This follows the same concept in computing the average collection period. The goal is to have shorter average days in inventory. A shorter amount would mean that the cash of the company is not being tied to its inventory for a very long period of time. Formula: Average days in inventory equals number of days divided by inventory turnover ratio.
Okay. So again, the number of days depends on the policy of the company if they are adopting 360 or the 365. So for example, purposes, we use 365 days divided by inventory turnover ratio. So mao ni siya ang atong na-compute, di ba? Previously. So for 365 divided by 2.38 in 2019, the average days in inventory, we have 153.36 days or 153. Then for 2019, we've got 132 days or 132.25 days. So what is our analysis? This means that the company will take 150 days in 2019 to sell the entire inventory for that year, while it would only take 132 days for the year 2020. The average days in inventory of the company improved in 2020 because the inventory turnover in 2020 also improved. So ganina, di ba, na-compute naman yung inventory turnover ratio. No, for 2020, we have 2.76. Paspas ang paghalin sa imong inventory of nag-improve po siya sa 2020 because we have only 132 days for the entire inventory to be sold. Okay. Mao na siya. Ganina times ang atong gi-compute karon days. So we only have 132 days. Next, number 8. Number of days in operating cycle. Kindly read, David.
These are the measures on how long it would take for the company to transform its inventory back to cash. This is the combination of the average collection period and the average age of inventory. The goal is to always have a shorter number of days of operating cycle. Formula. Number of days in operating cycle is equal to average collection period.
We have 175.27 days. For 2020, our collecting period is 20.77 plus days in inventory, 132.25. So the number of days in operating cycle is 153.02 days. It shows that there is an improvement. So saan na to pag-determine sa improvement, ma'am? Ato sa siyang i-minus. Pila man na siya, class? 175 minus 153. So we have 22. No? So naa siya improvement of at least 22 days now in the operating cycle. Kaya nagka-short man ang number of days. Pasabutan na nga nag-improve ang company as a whole now when it comes to selling products and collecting their receivables. We have the solvency ratios. Kindly read the definition. Angelica.
Solvency ratios measure the capability of an entity to pay long-term obligations as they fall due. Creditors of the company's long-term payable and bonds payable will be interested in knowing its solvency ratio.
Okay. So, kung sa liquidity ratio, ang atong focus kay mahibaw-an nato kung kaya ba sa company mo bayad sa mga short-term utang or obligations. This time, we will determine if kaya ba sa company mo bayad og mga long-term obligations as they fall due. So there are also types no, of solvency ratios. First type, we have debt to total assets ratio. Emeline, kindly read the definition.
Yes, ma'am. Debt total asset ratio. This is the proportion between the total liabilities of the company and its total asset. The debt ratio show how much of the asset of the company were given by creditors. As much as possible, current and prospective creditors want a very low debt to total asset ratio. Formula, debt to total asset ratio minus total liabilities divide total assets.
Okay. So kung sa current ratio, under liquidity ratio, ang atong focus is only the current. This time, total lagit siya. So for 2019, you have total liabilities of 1,600,000 divided by total assets of 2,300,000. So the debt to total assets ratio is 0.69. While in 2020, you have total debt to total assets is 0.68. Ang pangutana, what is the interpretation of the debt to assets ratio? Sige, higher debt to total assets ratio implies, unsa kay implication ana? There is a high level of debt, of course, no? Again
Yes,
ha,
ma'am.
so kung dako ang rate, so sa 2019, mas dako man siya kaysa ni 2020, so sa year 2019, medyo nagka-problema ang company kay dako pud ang level sa ilahang debt, di ba? Or utang. Next, number 2, we have debt to equity ratio. Kindly read, Eliza.
Yes, ma'am. Debt to equity ratio. Instead of assets, the debt to equity ratio compares the liabilities of the company with its equity. A smaller debt equity ratio would indicate a healthier solvency position for the company. The formula for this is debt to equity ratio equals total liabilities divided by total owner's equity.
Okay. So our analysis here, no, comparing the two period in accounting, the debt to equity ratio of the company for the two periods shows that the company was more solvent in 2019. Anong solvent man siya? Because a higher ratio suggests a high level of debt that may result in high interest expense. Times interest earned ratio. Kindly read Lynn Jaisel.
Times interest earned ratio. The time interest earned ratio shows the proportion between the EBIT of the company and debit naman,
EBIT.
EBIT of the company and its interest expense. It is an indicator of how many times the company's EBIT can cover the finance cost of borrowing. Companies want a high times interest earned ratio. A small or decimal number ratio indicates that it is not advisable for a company to borrow money, especially if the company would not be able to generate enough income to cover it. Formula times interest earned ratio equals to EBIT divided by interest expense.
Okay, EBIT stands for earnings before income tax. Okay, you have there now the formula divided by interest expense to compute times interest earned ratio. So for 2019, we have 10.66. While in 2020, we only have 2.33. So what is our analysis for this? Now, comparing the times interest earned ratio for the company of the two periods, we can conclude that the company is very solvent in the year 2019 compared to the year 2020. Ngano man ma'am, because it is 10 times more solvent to pay the interest with its income before tax. The profitability ratios. Now for profitability ratios, this measure the ability of the company to generate income from the use of its assets and invested capital as well as control its costs. So for the first type of ratio, gross profit ratio, kindly read Shannon Lay.
Gross profit ratio. This is the proportion of gross profit of the company its net sales. Gross profit is the difference between the net sales of the company and its cost of goods sold. A company should aim for a bigger gross profit ratio. A large gross profit ratio shows that a company can generate more sales from the smaller cost of goods sold that it has. Formula gross profit ratio equals gross profit divided by net sales.
For 2019, we have GPR of 80%, while in 2020, we have 77.59%. Now, what is our analysis? It means that for every 1 peso the company sells, 0.80 or 80% goes to the profit for the year 2019. So sa kada peso daw ko no, 1 peso nga halin no sales na ay 80% or 0.80 ang company ana for the year 2019. But for the year 2020, ning decrease siya, no? For every 1 peso, naalang siya ay 0.78, no? If we'll convert that one, or 78%. Pwede siya nato ma-improve, no? Say pamaagi by continuously finding inventories with lower cost. So pwede siguro ta mamili atong mga products na atong ibaligya nga dili na kaayo kinahanglan pa og dakong gasto, no? So naara gina siya sa manager sa business on how to decide well in choosing which inventory has a lower cost without sacrificing the quality. Imagine that you run a company that sold 5 million pesos in running shoes last year and had a gross profit of 900,000. What was your company's gross margin for the year? We are referring to the gross profit ratio. Okay. Wow, very good. All of you got the correct answer. It's 0.18 or 18%. Okay, very good. Now let's continue. Profit margin ratio. Kindly read the definition, Angelica.
Profit margin ratio. The profit mentioned here is the net income after tax. This ratio measures the proportion between the NIAT and the net sales of the company. This is more precise measurement of the company's profitability because it has already considered the operating expenses and other expenses of the entity. Companies want a high profit margin ratio. Formula: gross margin ratio is equal to net income after tax divided by net sales.
Okay, so we have here for the year 2019, the gross margin ratio is 47%. Then for the year 2020, our profit margin ratio is 34.48%. Now, our analysis or interpretation is that the company earned 0.47 peso for every 1 peso of sales in the year 2019. Profit margin ratio shows a decline in the year 2020. No, we only have 34.48%. So, mas profitable ang business aning year 2019. And this can be attributed to a lower net income after tax coupled with the increase in net sales. Number 3, operating expenses to sale ratio. Kindly read the definition, Emeline.
Yes, ma'am. Operating expenses to sale ratio. Operating expenses are the biggest expenses of every company. It can be for sure classified into a general and administrative expenses and selling expenses. These expenses are needed to generate sales. This ratio should be minimized as much as possible. The goal is to generate as much sales with the minimum operating expenses. Formula: operating expenses to sale ratio equals operating expenses divide net sales.
Okay, so we have here for 2019, our operating expense to sale ratio is only 16%. For 2020, okay, much lower. We only have 5.17%. So our interpretation class, now comparing the 2 years, this shows that there is a huge improvement in the operating expenses to sales ratio. So mas gamay ang imuhang OE to sale ratio for 2020. Ang imong buhaton ana is mag-cut off ka sa imong expenses. Pagamyan din imong expenses. Answer this one for 2 minutes. If a company has assets worth of 500,000 and 100,000 in operating expenses with 400,000 in net sales, what is the operating expense to sale ratio? Okay, there are only 4 of you got it correctly. It's 25% or 0.25. Diba? The formula is operating expenses divided by net sales. So, pila di ay ang atong operating expense? We have 100,000. Then, our net sales is 400,000. Kani si half million for assets is flowering statement, no? Para libugon lang mo. Of course, you have to analyze carefully in order to arrive with correct answer. Any questions, clarifications?
Wala na, ma'am.
Alam,
Okay, let's call it a day. Thank you for your attendance. Ever naapag yung mga clarifications, please do not hesitate to ask me through PM or through GC so that everyone can interact. Okay, that's all for today. Goodbye and have a good day ahead.
Goodbye,
Bye,
ma'am.
ma'am.
Bye, ma'am.
bye
Bye,
ma'am.
ma'am.